Happy Friday, everybody. Getting ready to post another video. Today I want to talk about writing off a vehicle for your business. Um, there's a couple of different options with this, and I will throw in a little disclaimer at the beginning of this one. This is purely for um, tax planning, tax saving strategy. Different people are going to have different opinions on this. So this is definitely an interpretation of law. Um, and just like if you were to go to one doctor who says you need a surgery, you might go to another doctor that just wants to put you on prescriptions. If you go to another doctor, they're going to tell you, well, do this physical therapy. And you go to another doctor that's a holistic and they're going to be completely different. It's the same thing with any professional level service. So like doctors, attorneys, accountants, we're interpreting law, and that's why we call it practicing. I'm practicing tax strategy and consulting. Um, okay, so that's my disclaimer soapbox. Okay, so let's talk about this. First off, let's say you are running a sole proprietorship. So this means you don't have an LLC in place. Um, Typically, and so then there's different types of vehicles too. So let's talk about different types of vehicles. So first off, let's say you're running a business and you buy a fleet of vehicles and you have issued those vehicles to your actual real W-2 wage employees. That that's different. I'm talking about like the vehicle that you use for yourself. Now, the same rules kind of apply depending on both situations, but let's talk about that. So, if you have let's talk about traditional employees first. So, if you have a vehicle or a fleet of vehicles and you've issued them to your employees, technically you're supposed to increase their W-2 wages by the non-cash amount that you estimate they are using those vehicles for personal use. That's completely open to interpretation. So I worked for a large farm supply store, and uh, they had agronomists. So the agronomists would go out to the farms and try to sell fertilizers and pesticides and stuff to help grow the crops. Well, they were issued vehicles, and these vehicles, they drove them home, they took them with them everywhere they went. I mean, basically they could drive them to the bar and church and all these other places. And when I worked for this company, we interpreted it by saying for personal use of that vehicle, we increased their W-2s by $30. And the argument was that as an agronomist, they were constantly selling product in their local neighborhoods to their friends, their family, their communities. And so they were doing that every day. So we increased their W-2s by $30. Another the when I was in public practice under a different company, I went through an audit for a very large company. They were giving out trucks or issuing trucks to their traditional employees. They didn't do anything. So their foremans and their managers or whatever all had trucks, and they didn't even do anything for personal use. Well, in the audit, the auditor basically just said, well, you should be, but it was immaterial enough that they didn't even worry about it when we moved on with the audit. We didn't want to waste everybody's time. Um, so there's a couple of different takes on that, but the same rules kind of apply. So let's talk about um, use of your personal automobile in your business, right? So there's a couple of ways we can interpret this. Excuse me. So the first one, let's say you're a sole proprietorship with no LLC. Um, and you're using your personal vehicle for business. Well, when you are a sole proprietorship, there is no difference between you and your business. You are your business. There is no legal distinction between you and the entity. Therefore, you can't your entity can't own your personal vehicle because it's you. And so you own your personal vehicle. And so in that case, you need to keep a mileage log. And basically, anytime you have a business trip, or you go anywhere in your vehicle for business purposes, you have to keep the mileage tracker. So you can do that through an app, you can do that through a clipboard and a piece of paper. Basically, you need the date, the mileage you went, and the reason why you went somewhere. And you do have to keep what's called a contemporaneous log. Apps work great for that. Clipboards are look okay. But that's what you're supposed to do. Now, if you work from home because you're like a remote worker or you have an online business or whatever, typically we don't get very many business mileage, much business mileage on our vehicle. Um, and so this isn't usually worth the hassle. Uh, Now on the flip side of that, um, so let's say we're now an LLC and we're taxed as a corporation or whatever, a partnership, a corporation or something, but an LLC is legally separate from you for state, local, business law. But for tax purposes, it may or may not be distinguished from you as a sole tax as a disregarded entity, sole proprietorship, or as a corporation or a partnership or an S corporation. Like an LLC can elect to pretty much file taxes anyway. You just have to file the right paperwork. But let's say you're an LLC taxed as a corporation or an S corporation. Well, now your entity is distinctly different from you, and so it's capable of saying that it owns your vehicle. And so we could, just like any corporation in America, say that your vehicle is owned by the corporation and the corporation is issuing it back to you, just like any other large corporation in America. You just have a fleet of vehicles, which it's only one vehicle to supply that vehicle to the corporation's one employee. Well, then we fall back into those same rules. Every single dollar you spend to operate that vehicle has now become a business expense. However, we do still need to take a portion of that as personal use. So, and it's supposed to go through your W-2 wages and be subject to Medicare and Social Security tax. Now, like I said, I use very two large company examples of how you could interpret that aggressively, or you could do it by the letter of the law and actually figure out through mileage what is personal mileage and which is business use mileage. Then you have to keep a log again. Or you can estimate it. Like there's different reasonable methods, but it's all dependent upon how aggressive you want to be. For my clients, we typically take 10%. Just a kind of across the board, a standard percentage. We take 10% of all your vehicle expenses as personal use. Definitely more conservative than the two large companies that I gave as examples, but still could be considered aggressive, especially if you're a home-based business. Now, let's talk about actual expenses versus mileage. So you get one or the other. You can't take both. So actual expenses are things like the depreciation of the value or historical cost of the car you purchased, which is kind of the idea of your loan payment. Then you have insurance, registration, maintenance, so oil changes, tire changes, repairs, car washes. You would have basically any accessories or upgrades you put into this vehicle. Those are actual expenses. Every single dollar you spend to operate your vehicle is actual expenses. And so if you take the idea that we are contributing this vehicle to the corporation and then issuing it back to the CEO to operate for the benefit of the corporation and for personal use, then those are all business expenses under the actual expense method. And then, like I said, for my clients, we take 10% back as personal use. That may or may not be more or less beneficial than the mileage rate. So we do have the way the mileage rate works, it's published by the IRS every year, and we're hovering around 55 to 70 cents a mile. Where does that number come from? My guess is actuaries, but basically what they're doing is they're calculating the average cost of gas in the United States and average cost of maintenance and all those things and taking into account depreciation. But basically all those actual expenses that we talked about, they are average them across the entire country. And then they say, okay, you can take the mileage rate for business miles and it's for 2025, it's 70 cents a mile. that may or may not actually be more beneficial for you. So we have a lot of clients that are real estate agents that are driving all over their communities showing houses. We have Uber drivers, we have truck drivers. Typically, for people who are putting on a lot of miles on their vehicle throughout the year, we find that the mileage rate is better. So if you're that type of person or you're working in an industry of that niche, you might want to consider, well, am I putting 15 to 20,000 miles on my vehicle every year? It might behoove you to do the mileage rate. Get an app on your phone and just keep track of your business miles. Every time you get in your vehicle for a business purpose, keep track of the mileage. That'd be if I'm running to the bank to make a deposit, running to the post office to mail some sort of business form or package, or, as in the case of the realtor or the Uber driver, I'm heading to a property to show it, or the moment I hit on, I'm now, as an Uber driver or ride share driver, as soon as I hit on and I'm willing to accept people. As long as that button's on, I have business mileage. So those are kind of some of the options. Um, as a home-based business, typically we find actual expenses is better, where we contribute the vehicle, take it 100% as a business expense, and then allocate 10% back to our CEO for personal use. As a sole proprietorship, you take the mileage rate because you are your business and you own your vehicle. Um, if you're a corporation and you're a home-based business, we take actual expenses. If you're a real estate agent or you put it on a lot of miles, the mileage rate's typically better. Now, when you have an LLC and you buy a vehicle, the no bank in America is going to loan a very small business with no collateral um, money to buy a vehicle. They just don't do that. They loan money to individuals to buy individual vehicles. So unless you're paying in cash, typically you have to purchase the vehicle under your personal name. So you buy the vehicle under your personal name, and then when it comes down to tax law, it's all about facts and circumstances. There's a few things we can do to solidify those facts and circumstances. For example, you could do what's called a quit, QUIT, a quit claim deed, and you deed the vehicle back to your LLC. That is a way to show legally that the vehicle is now in your business. There is some risk to that. For example, if you get in a lawsuit, that vehicle could potentially come under risk of that lawsuit. Like you are sharing your vehicle with your business. Therefore, if your business is carrying any risk or liability or anything, that vehicle is also carrying that risk and liability. Conversation for your attorney. Um, that would be the proper way to do it. But facts and circumstances state that if I've bought a vehicle and I'm treating it as a business vehicle, it's being accounted for as a business vehicle, then it's a business vehicle. Um, like I said, there's more. An attorney's going to tell you, well, you need to have that quit claim deed. In an audit, if you have the quit claim deed, it's definitely going to provide more concrete evidence that you've done it correctly. But as a small business owner, I like to call it the Wild West for tax code, because really what it comes down to is facts and circumstances. How is it being treated? And that goes both ways. Sometimes that hurts us, and sometimes it benefits us, because it's all about how things are being treated. Sometimes you think something's personal, but you're treating it another way, and that means it's business, and so it actually could result in some additional taxes for you. So yeah, it can go both ways. But with that being said, as a small business owner, I've purchased the car under my personal name. I got the loan under my personal name. I'm going to have the insurance under my personal name as well. And honestly, that's because typically the insurance under a personal's name is cheaper than under a business name. Now, again, you quit claim the vehicle to your business, you pay for the insurance out of your business. It's fudging the line a little bit, but it's because it's all about facts and circumstances and how we're treating it. And so again, this is why, as a very small business owner, it's all open to interpretation and how aggressive you are comfortable being, and how much risk you are willing to carry. Just like really when we're talking about taxes, a lot of it has to do with, just like when you're talking with your financial manager and you're coming up with an investment strategy, how risk averse are you? And then let's build a portfolio around that risk. And it's the same concept because ultimately, when it comes down to it, tax law is completely open to interpretation unless it's been ruled upon in court. And really, the ultimate court is the Supreme Court. Well, not all cases go to the Supreme Court. So really, we're looking at multiple different jurisdictions to possibly set precedences, and then that's what's being negotiated in an audit. And that's really what it comes down to. And law, just like any law, is open to interpretation, and we can have court decisions completely overturned. Is it worth going to court over? Probably not, but that means it is open to interpretation. And until you're audited and you're sitting with the auditor, present your negotiation, your reasoning. Uh, it's up to you as the business owner. What is and is not a business expense, and how do you define that? So anyway, that's kind of my stance on vehicles. I hope this is beneficial. I get a lot of questions on vehicles, and so I really hope this helps clients and other people that are trying to navigate the tax code, how to make their vehicle more beneficial for their business as a tax write-off. Have a good weekend. See you next time.